The Fed raised the benchmark rate by 25 basis points as expected, and the committee retained its pledge to have ongoing increases in rates. Still, Fed Chair Jay Powell said for the first time the committee could conclude that the disinflationary process has started. But the question remains, with the Fed nearing its peak, how long before we see a pivot? A hot conversation well worth your 10 minutes right here on UBS Trending. Thank you so much for joining us, everybody. Let me introduce you to our guest for the show today, Eddie Ghabour, co-founder of Key Advisors Wealth Management. Eddie, always great to have you on the show. Welcome back.
Thank you for having me.
Great. So, Eddie, I want to start with the Fed, right? That's probably the most important topic, I think, that people are talking about right now. We know by now that the Fed at the recent two-day meeting raised rates by 25 basis points. Powell indicated that perhaps we'd see another one likely in March. Markets are pricing in another 25 basis point hike in May. So my question is, what do you think is going on in Powell's head here?
So, Powell obviously is realizing that some of the economic data is cooling off, but they've made it crystal clear from the beginning of this tightening cycle, whether you agree with what they have done or they haven't, he is deathly afraid of a repeat of the 70s, where they pivoted too soon and we had a reacceleration of inflation, and then you had to have that Volcker-like moment where they just crushed the economy by really hitting the interest rate market hard. So I think the Powell is comfortable with over-tightening. He actually said that in one of his press conferences. And this is why we've been so bearish, is we're taking them at their word. We do not think they're going to cut rates this year. And I know there's been a lot of people talking about pricing in 2 rate hikes at the end of the year. Here's what I've said to those folks. If you think the Fed is going to cut rates 2 times this year, then you actually agree with our thesis that we're going into a recession, because that's the only time they're going to cut rates. They're not going to cut rates if it's a soft landing environment. So they're in a really tough spot here, because I personally think they've already over-tightened because we're already heading in a recession, but they're going to keep doing it. And then when they stop, they're not going to cut. They're just going to pause. So it's going to be higher for longer.
Yeah, and that seems to be what we're thinking here too. But here's the question. Do you think that they will perhaps hold for a while after they raise 2 more times? Do you think they'll hold before they pivot for the rest of the year? What's your thought there?
Without question, they're going to hold. And they have to. And here's why. If they pivot and start cutting rates, you will see that initial reaction, as we all know, of asset prices going through the roof. And that's counterintuitive to what they're trying to do. And the other problem is the labor market's too tight. He won't admit this, and he probably can't say this on TV. But in my opinion, the only way they're going to get to that 2% inflation rate is by crushing the labor market. And the only way you're going to crush the labor market is by having a recession. So that is the unfortunate solution to this problem that we have. And that's why I think they're going to be very, very patient, even if the data is deteriorating, before they pivot. They are going to take their time, and that's going to be when we're hitting lows in this market, in my opinion.
Right, and by the way, for those that are at home keeping score, yesterday the latest 25 basis points marks the highest federal Fed funds rate since 2007, with probably 2 more to come. So we're going to be hitting records here. I want to ask you though, Eddie, because Powell did start to say the word disinflationary, which was the first time he said that. And he said he believes it started, but that the job isn't fully done, which we talked about here. How much of that do you think has to do with a potential weakening in the housing market? In the jobs market?
Yeah, well, that's why. And this is why, because let's face it, it's very odd to see the labor market still this tight, this late into the cycle. And this is why their job is not done. So yes, we are seeing disinflation in certain parts of the economy, but I would argue that part of the reason why is demand destruction is already underway, okay? And anytime you have a recession, inflation goes down because there's less demand. And so I think it's a combination of that, plus some supply chain issues loosening up for sure, but this is another reason why we think this recession has already started. Look, the consumer's tapped out. Look at all these earnings reports and what they're saying on any company that's tied to the consumer. They continue to talk about how there's a decrease in revenue and consumer activity, and that's not going to get better in the next 6 to 8 months. That's only going to get worse. But again, the labor market's always the last thing to crack, and that's why the Fed can't pivot and won't pivot, because they're not going to do it with a tight labor market. They've told us that.
And yeah, you mentioned talking about earnings here. Most of the expectations from our chief investment officer that earnings are going to be flat to down now, considering what we've seen already and how even companies themselves are taking down their own estimates and still not even beating. So do you think that you're going to see some pullback? Because we've had pretty great equity performance so far since the beginning of the year, but what does that look like for you going down the road?
I think we're going to hit new lows before we hit new highs. This, to me, the activity and the action, when you look at some of these stocks that have really ripped, right, they're your highest short interest stocks. So certainly there's people getting squeezed. But some of these companies have extremely poor balance sheets, and you're seeing these huge rallies. And the other thing, too, we've educated our clients on this. You have the biggest short-term rallies in bear markets. Okay, so the activity that we're seeing here in the first, 30 days of the year is very typical in a bear market, and to us just confirms that our thesis is right. Because at the end of the day, fundamentals will matter. This market is not pricing in a recession, and it's not pricing in an earnings recession, and it's pricing in 2 rate cuts. And I don't think any 3 of those scenarios happen, which means if we're right, we have 20% more to go on the downside from the current levels that we're at.
Right, yeah, because you're right. The market is pricing in a little bit more of a, I wouldn't say a rosy picture, but maybe a less frightening one. So yeah, I think it's going to be, if your estimates are correct, there's going to be a little bit of a hiccup here as we head down the year a little bit. So let me ask you this, Eddie. If investors right now, there is a lot of uncertainty, whether you think the Fed's going to cut rates at the end of the year or as you're saying they won't. Where can investors go right now? Where should they be thinking of putting their money to work in this kind of uncertain environment that we're currently in?
So this is a rare instance in my career where we have basically gone to cash for a big percentage of our client assets. And one reason why is we're finally getting yield. I mean, you can get 4+% on money market rates right now. And if you think things are going to deteriorate over the next few months, there's nothing wrong with just being patient and sit on the sidelines, right? Because worst case, if we're wrong, you just missed out on a little bit of a rally, but you didn't lose any money in that scenario. But if we're right, you're going to have a lot of dry powder because we think 2023 is the year that you can set yourself up for massive gains down the road. Because if we do go into a recession, there's going to be some amazing buying opportunities. So that's how we are set up. And look, sometimes the best investment strategy is just doing nothing in regards to just be patient with money on the sideline. Because you talk to your most successful folks that have grown net worths is because they put themselves in a position to be able to buy recessions. And that's what I think investors should be considering right now. Because one last point I want to make, I didn't bring up last time. The other big cloud out there that not enough people are talking about is the cost of capital. The amount of corporate debt that's going to get refinanced at substantially higher rates, commercial real estate that's going to get refinanced at substantially higher rates. I mean, how can you increase the cost of capital and the cost of doing business during a recession where the consumer demand is going down? That's the worst scenario for a business.
Right, exactly. And Eddie, we can't forget that yields on the 10-year are down around that 340 level. I mean, look, we're coming up from 1% just about 2 years ago. But, where we end the year, we could be sort of sitting at these same levels again with an inverted yield curve. There's a lot of other factors and variables that are going on out there.
Yeah, and look, the ISM data continues to get really weak. The yield curve, right? I mean, the 3-month and 10-year has, in our industry, is looked at as one of the most important indicators for a recession from an inversion perspective. I can't remember if in history if we've had an inversion this wide before. So everything from the consumer to earnings to ISM, the bond market, it's all screaming recession. And so we're dealing with a bear market during this. So you have to decide if the bear market rally has more teeth or is the fundamentals going to override the market? And again, I think fundamentals at the end of the day usually wins. And that's how we're playing it.
Right, exactly, Eddie. And I was going to say, that seems to be the most important takeaways that we have for this conversation today. And let's not forget, we've had an inverted yield curve for a year. We could have another year of an inverted yield curve, some kind of record there too. Very interesting times. But Eddie, I want to thank you for joining us. It's always too quick and too soon to have you on, and we always wish we could have you on for a few more. But great to see you, Eddie, and we'll have you back soon. Well, thanks for sticking around with us today, everybody. If you would like more information, please visit our website at ubs.com. /views, and follow us also on social media. We're on all the platforms, LinkedIn, Facebook, Instagram, and Twitter. Plus, all of our past UBS Trending episodes are available for you to view on demand. And as always, if you do have any questions about what Eddie and I spoke about today regarding your portfolio, make sure to speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone, and remember to keep your eyes on what's trending. We'll see you soon.